Warm welcome to you and thank you for joining us this morning for the Nedgroup Investments Medium-Term Budget Policy Statement Post-Analysis. I'm Dimisha Greater, Investment Analyst at Nedgroup Investments. Well, South Africa Finance Minister Enoch Godongwana delivered his maiden medium-term budget policy statement yesterday. Now, as the country's new finance minister took to the podium yesterday, he still had to address and face the same old challenges that the country is currently facing. So the MTBPS is proposing to maintain restraint in terms of public expenditure. The government has said that they will not be committing to any new long-term spending in response to the temporary revenue windfall that we've seen, and will also have no additional funding that will be provided to state-owned companies over the medium term. In terms of market reaction, it was positive. So on a day when we saw the US dollar soar to its 16th month high, we did see the rand strengthen during and immediately after the speech, and we also saw local bond yields drift lower. But to help us take a closer look at the numbers tabled by the minister, we have Nedbank's Chief Economist, Nicky Weimar. Good morning to you, Nicky. Thank you so much for joining us this morning. There's obviously a lot to unpack here, and we have now digested what the minister has tabled for us yesterday. You've had a look at those individual chapters, so help us make sense of these numbers. Please take it away with your presentation, and thereafter we'll delve into a quick discussion. Over to you.
Thank you very much. Yes, indeed. I mean, this is our aim, is to unpack this budget for you and also to evaluate it. But to be honest with you, there is literally not that much in this particular medium-term budget policy statement. So to set the broader scene, what do we know? We do know that for quite some time that South Africa its finances are fundamentally weak. This is something we've known for quite some time. Really, since 2019, this country has been living beyond its means, with government expenditure outpacing government revenue to the amount equivalent to over 3% of GDP, which has generally empirically been tested to be a completely unsustainable situation. A nation should ideally not run budget deficits of over 3% of GDP for an extended period of time. And in the case of South Africa, we've been doing that for over a decade. Of course, the pandemic made everything a lot worse. As you can imagine, the pandemic and lockdown resulted in an implosion in tax revenue, while government spending had to increase in order to deal with both the health crisis itself and the economic consequences of lockdown. So this is where we find ourselves. And so in February this year, we had a sense of exactly the damage the pandemic and lockdown had done to government finances. In the national budget, the finance minister indicated to us that the deficit would balloon to 14% of GDP, and the country's debt burden would increase to over 80% of GDP. And the aim back in February was to slowly and systematically, but in no way dramatically, chip away at that budget deficit and try and stabilize what is essentially a very big debt burden. So that was in February. And since then, we know that things have improved. Fiscal conditions have improved. But very importantly, government got lucky. Okay, and that is what it's all about. So where did the luck come from? Well, the economy generally rebounded a lot faster and a lot stronger than anyone expected. All right, at the same time, in September this year, Stats SA and the South African Reserve Bank undertook their 5-year, which it was a year late, it was meant to happen in 2020, but they undertook their 5-year revisions of the GDP numbers. And so they revised it to best practice. You saw changes in classifications between different sectors, and you also saw a rebasing to 2015 as your new base year. And the outcome of that benchmarking exercise was that GDP was revised up between 9% and 11% between 2011 and 2020. So much so that last year, the economy only contracted by minus 6.4% instead of the minus 7% that we initially thought it contracted by. So the GDP numbers, especially nominal GDP, was revised up quite substantially, and that made a big difference to government's fiscal metrics. And at the same time, despite that technical upward revision, there has been a genuine economic recovery, or rebound rather, taking hold in the economy. And this happened from the moment we went from level 5 to level 4 lockdown. Essentially, that allowed more industries to operate. Government got smarter with every successive wave of COVID in terms of how they applied their lockdown measures. They targeted them better, and therefore they got a better health outcome without completely slaughtering the overall economy. So we've been climbing up this very steep hill from the pit we fell into during level 5 lockdown. So much so that by the end of June this year, the economy was 1.1 percentage points short of the levels that prevailed prior to lockdown. So we were almost back to pre-pandemic levels. And in the first half of this year, the economy grew by 7.5% on a year-on-year basis. So a lot stronger than anyone expected. And naturally, government gets its fair share of that recovery, in that it experienced quite a nice and robust rebound in tax revenue. And so that was a big supportive factor. But it's not just the fact that the economy rebounded stronger and faster than anyone anticipated. It's also, of course, the fact that the nature of this recovery has been very supportive of taxes. And that came in the form of exports rebounding very strongly. In fact, the lift in the economy since we emerged from level 5 lockdown last year came from moderate growth in consumer spending and a very strong rebound in export growth. So exports essentially outpaced imports, resulting in a big trade surplus, resulting in a nice current account surplus of over 5% of GDP, which of course provided a very meaningful boost to the overall economy, but also to tax revenue. Now, what supported exports was essentially a very strong rebound in the world economy. And we saw this especially in advanced countries. In the US, we've seen an exceptionally strong rebound. They have basically recouped all the losses caused by a strict lockdown in the second quarter of last year. Equally, China has also pretty much recouped all the losses caused by strict lockdown. The Eurozone is almost there, staged quite a convincing recovery, especially in the second half of this year. Elsewhere in the UK and in Japan, the recovery has been less compelling. They're not quite back to the levels that prevailed prior to the pandemic, but they are moving in the right direction. And if we look at the rest of the world economy, you see a similar type of picture. Sharp contraction second quarter of last year, followed by a fairly compelling rebound in the second half of last year and into the first 3 quarters of this year. And what, of course, brought this about is that we learned more about COVID-19. We became better at actually treating COVID-19, the medical profession, that is. At the same time, the private sector adapted very rapidly to the lockdown measures, accelerated the adoption of digital ways of working, digital ways of selling and marketing their goods and delivering their goods. So that made a big difference, private sector adaptation. And then, of course, governments got smarter in terms of their lockdown, targeted the lockdown measures a lot better. And then, very importantly, we discovered a vaccine. That was a game changer. And in your advanced countries, we've seen a very rapid rollout of those vaccines. We're now at a stage in most advanced countries where they're very rapidly administering booster shots, and they're also rolling out vaccinations to children under the ages of 15. So in a very different situation than many emerging market countries, your advanced countries rebounded very strongly. Added to that, being rich nations, they had a tremendous amount of space to provide fiscal stimulus, which was truly extraordinary, directly supporting households and companies through the crisis. And of course, they provided an enormous amount of monetary stimulus. This is stories that you are very familiar with. So we saw a very nice rebound in global growth. And what that essentially did is it created demand for commodities, and we saw a very strong rally in commodity prices. The rise in commodity prices is also partly the result of the fact that you've had a lopsided global recovery, right? You've had a very strong surge in demand from advanced countries, but a lot of the goods and services they demanded used products that were either sourced or materials that were sourced from emerging and developing countries or processed in emerging and developing countries, among other commodities. And of course, most emerging and developing countries have not managed to vaccinate the bulk of their population, still had to deal with COVID outbreaks, still had to impose lockdown. And so that caused all sorts of supply shortages. And at the same time, it disrupted the global transportation system, logistics and transportation system. And as a result, we are now dealing with a situation globally where we have fairly widespread and extensive and acute supply chain problems. And all of that's been driving up prices, not just of commodities, but across the board on many, many products, which is why we've seen inflation return in a fairly compelling and convincing manner in both advanced countries and emerging economies. So the surge in global commodity prices provided an additional boost to our exports. We are primarily a producer and an exporter of commodities. And so as a result, what essentially happened is that mining profits shot up, something that hasn't happened for many, many fiscal years. This graph really shows you where government got its tax revenue from. It shows you fiscal years 2018, 19, 19, 20, last year, 2020, 21, and then this fiscal year, which is 2021, 2022. And you can see where mining has really not done spectacularly in any way during the previous 3 years. For this particular fiscal year, profits shot through the roof, and it provided a nice little windfall gain for government in terms of taxes. So they got very lucky. Here's the thing, though. There is nothing permanent about the surge in commodity prices. It could prove to be more resilient than anybody is anticipating. If the US gets their infrastructure program going, if the EU gets their infrastructure program going, if the world at large, including all the private sector companies, take the transition to renewable energy, to green transportation systems very seriously, then we could see a wave of investment globally, which could result in sustained and strong demand for commodities. And that could turn the current upswing in commodity prices into a more long-lasting rise and resilience in commodity prices. So it's not necessarily the case that commodity prices are just going to fall, but as a fiscal strategy, you can't really rely on commodity prices to do the heavy lifting for you. And listen, folks, that's what did it. Firstly, a stronger and faster domestic economic recovery. And secondly, the surge in mining exports that has been amplified by the rise in global commodity prices. And that made all the difference for government. And so as a result, your revenue came out a lot higher than they expected in February this year. And there I show you the latest estimates for tax revenue going out until 2024-25. And then you can see for this year, which is 21-22, how much higher. And in fact, it's very significant, 128.4 billion rand higher than they estimated in February. And that's all really the impact of that windfall gain from commodity prices that boosted mining profits and therefore boosted corporate tax revenue. Right, so that really is it. But it's not just taxes that fared better than they anticipated. They also spend more than they budgeted in February. There you can see now I show both of you, both those indicators for you. I show you expenditure and I show you revenue. And you can see that expenditure has also been higher in this fiscal year, 2021 and 2022, than they budgeted in February. Of course, the impact of revenue has been far more significant because it's been a lot higher than budgeted and far more so than expenditure. But the reality is the gap between revenue and expenditure is still enormous. Okay, you can see these are absolute numbers, so there's absolutely no illusion here either. There is an enormous gap between revenue and expenditure, even with the better than expected outcome. Now, the reality is that if we did not have the rebasing in nominal GDP, this would not have looked much better than we saw in February. But it was that rebasing in GDP that made the enormous difference, okay? Because what that meant is if you express your deficit as a percentage of the size of your overall economy, which is your GDP, you now see a much better picture reflected. And for now, governments opted to stay on the straight and narrow. So they've opted to take this windfall gain and translate that into a faster rate of deficit reduction. And the markets, as in fact has been said, responded very positively to that. So they want to now bring the budget deficit down from 7.8% this year, which is already a lot better than they thought they would achieve in February, when they thought we would only get to a budget deficit of 9.3%. But they want to bring it from 7.8% this year all the way down to 4.9% by the time we get to 24-25. A very important thing to remember here is although the budget deficit is a lot smaller than we thought it would be in February, this is a case of us going from something that is absolutely frightening to something that is just slightly frightening, but it's still frightening, all right? And that's the key point here. Government finances with a deficit of over 3% of GDP is still wholly unsustainable. And I'll illustrate that to you as we proceed. So yes, they did at least opt to reduce the budget deficit, use that windfall gain to bring the deficit down significantly. That does not change the fiscal challenge. It is going to be extremely difficult to meet those deficit targets. It is going to be extremely difficult for them to bring the budget deficit down from 7.8% of GDP, which they estimate it will be this year, to 4.9% of GDP by the time we get to 24-25. This is what they're going to have to do. They are going to have to dramatically cut non-interest expenditure as a percentage of GDP, all right? So non-interest expenditure is really the expenditure by government that are supposed to make a difference to the population. This is expenditure on social welfare, on education, on healthcare, on economic infrastructure, on everything that raises your long-term potential growth and provides support to the economy in the short term. And that will have to be cut dramatically down to only 25.8% of GDP by the time we get to 24-25. Just to make that deficit target. So what does it mean? Well, revenue is budgeted to increase by 4.7% per annum over the next 3 years, which is the entire period of the medium-term expenditure framework. And they will have to contain expenditure growth to 1.7% per annum over the next 3 years. This has never been done in South Africa. So they are setting out to do something they themselves have never succeeded in doing. Non-interest expenditure, well, they're going to have to cut that. They're going to have to cut that in nominal terms by 0.4% per annum over the next 3 years. Again, never been done before. Now you adjust that for the effects of inflation, and you are talking about deep inflation adjusted or real cuts in government spending. So this is indeed a budget that proposes for the next 3 years continued expenditure constraint. Why is it necessary? Because as I told you before, our finances are fundamentally weak. We've been running budget deficits of over 3% of GDP for an extended period of time. That shortfall has been financed through borrowing. Our debt has been climbing. Given the fact that we've not been growing for a decade, we've been in a process of economic stagnation for a decade, we've been subjected to the deterioration of governance in South Africa, we've had a series of sovereign risk rating downgrades that have brought us to the point where we now essentially are a universally junk status nation. Of course, the risk premium to funding South African debt has gone up a lot. And with that, the interest cost of funding South African debt has gone up a lot. And as a result, debt service costs continue to rise, and it continues to crowd out all other types of spending. And it's because they have very little control about what happens to debt service costs that they have to cut non-interest expenditure so significantly in order to reduce the budget deficit. This gives you an idea of what's going to happen. Debt service cost remains the fastest growing item in government expenditure. It is set to grow by almost 16% this fiscal year, and it's going to grow at a rate of 10.8% per annum over the next 3 years. Ultimately, it's going to eat up 21.7% of main budget revenue. That's an enormous chunk of tax revenue that goes simply towards servicing your debt, which you could have applied to things like building houses, building general economic infrastructure for communities, putting in general public transport systems, improving your healthcare system. So that's the poison of debt service cost. But it is what you bought on yourself by borrowing excessively. That is how we got to the situation where we are now. And so they've got no control over that. The only thing they can control is non-interest expenditure, and the debt situation is now such that they'll have to cut that over the next 3 years. The other thing that is increasingly eating up more and more of tax revenue, and therefore also consuming a big portion of government expenditure, is the public sector wage bill. Now, their ability to meet those deficit targets will depend to a large extent on what they can actually do in controlling the public sector wage bill. And while in theory, government should have a lot of control over the public sector wage bill, in reality, they don't seem to have much. They did manage to impose a wage freeze last year. This year, they've settled for more than they've wanted to settle for. They have allowed for a 1.5% increase in wages in nominal terms, so it's still a real wage cut. And at the same time, they have provided once-off payments to civil servants from a certain level downwards. Now, that they did not budget for, so that adds even more to the wage bill. And at the same time, the wage freeze of last year has, of course, been taken to the Constitutional Court by the unions. And if the court rules in favor of the unions, then of course that throws all government's calculations out, because government might then have to, they will then have to provide compensation for 2020, 2021, in line with the previous wage deal, which was massive. It was, I think, inflation plus 1%. So totally out of the level that they can afford at this point. And their aim is to continue to cut the public sector wage bill. But a huge uncertainty hangs over that outlook, because the unions are going to resist them every step of the way. Another interesting little bit of detail they provided in the budget is they showed how the civil service is aging, that a huge percentage of civil servants are in fact 50 years and older. And it's particularly acute in the education system, where, believe it or not, 45% of all civil servants, teachers all the way through to administrators that work in education, 45% of them are 50 years and older. So government has to control the wage bill, but at the same time, they are sitting with a civil service that is aging, and they will, to some extent, have to re-employ people going forward. All right. So, of course, going into this year's budget, so now that you see the scene, that if you even want to think of reducing your budget deficit, given that you can't control your state debt service costs, given that you really don't know what's going to happen to public sector wages, and that composes over 30% of total expenditure, the space that you actually have to provide a basic income grant, which was the big speculation going into this particular budget, is exceedingly limited. One of the interesting little bits of information that National Treasury provided in this mini budget is they launched an attempt to calculate the actual social wage in South Africa. So as you all know, everybody's asking for a basic income grant for all of those that are unemployed. Now, one of the points they make is that South Africa spends a higher percentage of GDP on cash grants than the vast majority of developing countries. Over 18 million people in South Africa receive some form of government assistance, whether it be in the form of a grant, whether it be in the form of a child support grant, but over 18.3 million people. That is enormous. They've also pointed out that given the weakened public finances, new spending commitments can only be funded by closing existing programs to free up revenue, or through permanent increases in revenue collection, which is National Treasury's code for tax increases. So a key point they make there is that, listen, the scope is simply not there. And then on top, they also make the point that, listen, if we had to calculate what the social wage is, then you can see that we already spend an enormous amount of money on social expenditure. And the social wage is calculated as a percentage of non-interest expenditure for this fiscal year to be 60.2%, and to be, in fact, very close to 60% for the next 3 years. So how much more can you give? None of that is, of course, job generating. None of that is growth boosting. It really is just protecting against extremity or extreme poverty. Now, we already have a lot of that. We are already making enormous effort to protect against the consequences of extreme poverty. So for now, they seem to have put that notion on ice. However, they're clearly investigating it. However, they're clearly debating it. But it is just blatantly clear that the scope to add even further to that 60% social wage is extremely limited. What does it all come down to? Well, it all now comes down to the fact that we do have a slightly better debt trajectory. All right. Now, I show you there in yellow, these are the debt to GDP numbers released in February. Okay, and then the red line shows you the impact of the GDP revisions. So the fact that GDP was revised upwards already made an enormous difference. It brought your debt burden down from 80.3% to 72.7%. Now you add to that government's determination to reduce the budget deficit a little bit faster, and then it brings your debt for this year, for last fiscal year, down to 70.7, and for this year to 69.9. But here's the thing, as I said before, you are still running budget deficits of over 3% of GDP. So you are still borrowing and adding to your national debt on an annual basis every single year. And essentially what happens is that means after we come down this year to 69.9% debt to GDP, debt again starts to climb. It peaks at around 78.1% of GDP in 25-26, and then the aim is to slowly bring it down to around 75% of GDP by the time we get to 2029-30. So you can see government has a long road ahead of it, And with that high debt burden, the underlying dynamics are so vulnerable. You can have a public wage bill that is higher. You can have growth that disappoints. You can have a sudden downturn in commodity prices, and then your revenue projections look completely different and your debt level goes suddenly up. So all of this is incredibly vulnerable, and it will require tremendous discipline and tremendous constraint going forward in order to ensure that you at least contain your debt burden to what is already a very high level. And the hard truth of it is that compared to our peers, we do look ugly. South Africa is still going to record the biggest increase in state debt, or among the highest increases in state debt in the emerging market universe. The only countries above us over the next 3 years will be Thailand, Sri Lanka, and the Philippines. So we are still, adding to our debt burden faster than almost all other emerging markets out there. So not looking good from that perspective. So that's where we are. We are still in a tight fiscal position. We still face an enormous challenge ahead of us. Government will have to cut non-interest expenditure. They'll have to do that even as pressure mounts for a basic income grant. Okay, and they are entering and still sit with an economy that is very much constrained by persistent load shedding, by other structural constraints, by the threat of new COVID outbreaks, by the possibility that commodity prices could start to moderate, they could even start to fall going forward. So there's a lot of uncertainty attached to all of the numbers they put out there, which means that the one thing they can control, which is non-interest expenditure, they really should control. So the budget is not going to add to growth in the years ahead. The best government can do is to slowly try and improve our fiscal position and get us on a more sustainable fiscal path, and that is going to require sacrifice. So what is good about this budget? It does reflect improved fiscal metrics, even though the bulk of that is really just the result of luck. It does reflect expenditure restraint, and for that, it needs to be credited, and that is what the market also reflected. They were pleased by that element. I think the decision on the basic income grant has been delayed. That's a positive. And it also stresses the need to really accelerate structural reforms and raise business confidence. On the negative side, we are debating the prospect of a basic income grant. The gains that we've seen in tax revenue is undoubtedly temporary. And the deficit and debt is still at completely unsustainable levels. So we're slowly moving in the right direction, but we're crawling. And it's going to require a tremendous discipline to get us back on a more sustainable path. Thank you very much.
Very much appreciated. Of course, we always do like the way that you present these big issues to us. You just always have a way of making it so simple for us to understand. I'm going to go back a couple of slides, and maybe a good starting point for us would be to talk about the growth outlook. So as you said, National Treasury is expecting that for this year, for 2021, we'll be sitting at about 5.1%. Over the next 2 years, we should average at 1.7%. So National Treasury sometimes has these scenarios in terms of growth forecasts, and these are called deviations to what they currently have. So under scenario 1, what they are expecting is that we could increase GDP by 0.8% by the year of 2024. On scenario B, or the downside, they are expecting that we could shave off 0.5% by 2024. So I guess the question I'm asking you is, are you able to shed some light on what needs to occur in the economy, or what conditions need to prevail for either one of these scenarios to take place?
Okay, so on the negative scenario, I mean, that given the risk that they highlighted in National Treasury, so I think their reasoning on that front is firstly a relapse in the global recovery, which is not entirely impossible given that the world is dealing with inflation. It's an old enemy. A lot of the central bankers out there today have not dealt with inflation at all. Their biggest threat has always been deflation. You could perhaps see policy mistakes that could disrupt global momentum. At the same time, you're dealing with very frothy, and I have to say, it appears to me dangerously overvalued global financial markets, especially equity markets. So there could be an accident that could derail the world economy. So there are a lot of elements in the global economy. At the moment, the general assumption is that the recovery continues, right? But there are a lot of elements there that imposes and poses a substantial amount of downside risk. So in their downside scenario, they assume a relapse in the world economy. They assume, therefore, an implosion in global commodity prices. South Africa suddenly experiences a drop in its exports, and all of that revenue boost we got then dissipates, and you collect a lot less revenue from mining companies than you would have. And also your overall economy is hit by weaker exports, potentially a weaker rand, higher inflation, higher interest rates. As a result of that, domestic demand slows, taxes in general decline. So that's one scenario, one element of that scenario. Another process that could bring about the negative outcome is, of course, that we have further waves of COVID-19. We have continued lockdowns. More of them include, things like alcohol bans or bans on sit-in dining. And as we saw, those can be particularly destructive. And potentially you also have greater social instability, and you see more damage as a result of that. So the other scenario is that a lot of the weakness comes from the domestic front because of the slow rollout of vaccinations. So those are sort of the two main elements they are playing with on that front. And then, of course, also another risk factor they considered that could bring about the negative scenario is essentially a complete collapse in the electricity grid. So all of that brings them to their negative scenario. On the positive scenario, it's really just the reverse of that. They look at a situation where you could see perhaps stronger than expected global growth. Now, that is possible if the world, for example, makes very good progress in terms of rolling out vaccinations, and there's a global effort to get and assist developing countries with their vaccinations, and we overcome this COVID issue a lot sooner. Then you can imagine that the world at large will open up, more economies will open up with a greater sense of permanency, and you could see this catch-up scenario where emerging market growth suddenly accelerates, catching up with advanced countries. Also, you would then tend to see the return of global travel. And once that happens, of course, a lot of emerging markets will be supported. Countries like Thailand, like South Africa, like Brazil, that rely on a lot of tourism for economic growth, for job creation, and also for foreign exchange earnings would benefit from such a scenario. So that feeds into their positive outlook. And of course, under their positive outlook, they assume that there's a rapid uptake to the 100 megawatts embedded generation, that they move quicker with the deregulation of the energy sector in general, that they move quicker to install renewable energy, and that there is generally, as we've already seen to some extent, international support helping South Africa accelerate in this transition to green energy and green transportation systems. And the outcome of that is more job creation, more taxpayers, and a better fiscal picture. So those are how you could see the positive pictures come through. So really, in many ways, it's just the reverse of some of your negative assumptions.
Nicky, I definitely want to, hold that thought on us moving forward in terms of a just transition when it comes to our commitments to green energy. In the first scenario, you mentioned a couple of risks, and unfortunately, we can't talk about fiscal risk within South Africa's fiscal framework without addressing the issue of state-owned enterprises. I think one of the things that we've seen in the headlines that journalists or in the media or whatever the case may be would be that the finance minister has said that it's time for tough love on SOEs. From your take, I mean, was this anything different from what you've heard before? And what does this mean? That it's time for tough love, given that the likes of Eskom are still very much dependent on government guarantees, but they said they won't be extending any further bailouts. Maybe put that sentence into perspective for us.
Yeah, no, for certain they said so. So they didn't budget in the mini budget for any allocations to state-owned enterprises. But like all things related to government, there's a lot of double speak, right? So they say they won't budget for it, but they acknowledge that a lot of state-owned enterprises find themselves in dire straits. So they kind of open that door to saying, well, if worse comes to worse, we might have to bail out a few more state-owned enterprises. But clearly they're not aiming to do that. And they've also said that they will be applying very strict rules and regulations. They already announced that in February in the budget. So that's not new for any funds that go to state-owned enterprises again. And so the aim there is really to try and encourage state-owned enterprises, because the penalty is quite significant if you were to take government bailouts. So the aim is really to try and encourage state-owned enterprises with the stick to go out there, reform their operations, and lessen their dependence on the fiscus. Now, that has not happened to the extent that I think National Treasury might have preferred. But the general rule is that the bar for further state support have been set high. That's the language we're talking about. If you're facing an implosion, who knows? Maybe there will be further bailouts, but the bar has been set quite high. So they are kind of drawing a line in the sand and saying to here and no further.
Nikki, one of the other key points here has been around debt servicing costs, and that's been an item that I think a lot of us have been watching steadily increasing over the years. And I think you've pointed it out so well that this will ensure, or this will mean that we're going to be, crowding out investment. Unfortunately, we will have that expenditure that is so needed to be plowed into, programs such as health, education. We'll have less money. So now that we need to embark and continue on this track of ensuring that we narrow the budget deficit and at some point see a budget surplus, could we still continue to grow, given that you are taking money from very key programs that are needed to grow the economy? So, I guess what I'm asking is, can we actually do both?
Can this be done?
Is it practical? Yes.
Yeah, you could, but you'll have to change the way you approach your economy. So in other words, the bottom line here is government can't drive this recovery. Government cannot drive job creation. Government can work on improving the general legislative and regulatory environment to ensure that growth can occur. And that should not cost them a huge amount of money. In fact, that should not cost them any money whatsoever. All right. So they can create an enabling environment, something that we haven't had for over a decade. And if they manage to do that, they can still be shrinking the deficit and cutting their spending while the private sector takes over the engine of growth. So what has happened really since 2009 to date is that the public sector has grown enormously as a percentage of GDP. So we tried to drive economic growth through public spending. All right. It failed miserably because unemployment rose further. Our infrastructure deteriorated even more. I mean, we all know the story. We built 2 new power plants that are completely flawed and completely inefficient and didn't raise our potential growth or get rid of our electricity constraints. So you don't want to repeat that again. You don't want to go down that road again. That has been exceedingly costly, and it's got us to the very difficult situation where we are now. So yes, you can still grow, but what this means is that government can't be the impetus to that growth.
How confident are you that we would see the private sector come to the party? I mean, the minister mentioned a funding gap of around 441 billion. There are some projects that are on the table. We need to fund infrastructure. Looking at gross capital formation, it's been in decline. The public sector, has been a big creator of those jobs, and now the private sector needs to come to the party. So, would you say that this budget is one that is geared towards a business-friendly type of budget, where it would then give the confidence to the private sector to try and plug this funding gap?
I think it has positive elements. And like I say, we've been slowly crawling in the right direction, but it's not bold enough to suddenly change and suddenly create a positive sentiment among businesses. There's still a lot of legislation out there that is very destructive and that needs to be reviewed. But there are also hopeful signs, encouraging signs. But the hard truth of the matter is that we don't have electricity. There is a direct positive correlation between the cost and the availability of electricity and economic growth and wealth of a nation. So there's a direct positive relationship between those two. So if you don't have electricity, you cannot grow. It's not a luxury, it's an essential. And so it's going to constrain our ability to grow. The one thing I do have to say is I think the private sector is incredibly adaptive in South Africa, incredibly resilient, incredibly flexible. We are already seeing, you may have read in the media, of retailers, manufacturers taking up that 100 megawatts of embedded generation and actually planning their own solar facilities to move off the grid. So I think increasingly you will see that, you will see an uptake, but in the interim, it's going to be touch and go.
Nikki, one of the points that you mentioned about this particular budget is the commitment that we're seeing from a social perspective in terms of the social wage, the relief packages, to deal with the impact of the COVID-19 pandemic. We have, suffered a series of traumas or shocks in South Africa. I mean, we had the near collapse of Eskom, the COVID-19 pandemic. I guess my question to you is, given where we are now, and we don't know what's going to happen in the future, does South Africa have the fiscal space to respond to possible future crises? You've seen how the big developed economies were able to really pull together and help their particular economies. Should we have fourth and fifth waves? Is South Africa going to be in a position where they could pull themselves out of this hole? I mean, what concerns you about where we are now?
Yeah, I would say that we probably, thanks to the revision in GDP numbers, if we are willing to go back into the 80%, 85% debt burden level, there is fiscal space. But I would say that if you want to move in a sustainable direction, you really don't have fiscal space. So it depends on what you want to achieve. If you're quite willing to live with that enormous debt burden and all the risks associated with that, then you can go out there and you can provide further support if there is another shock. But the reality is that actually it is extremely limited. Ultimately, you've got to always weigh up whatever you provide now against the threat of you disrupting your future recovery because of excessive fiscal risk.
Nikki, earlier you spoke about the transition or the green transition in South Africa and how this could be a positive in terms of growth creation, etc. So how South Africa is in the grand scheme of things, looking at the African continent, the National Treasury says we are the largest emitter of greenhouse gases and the 12th largest globally. I think already this month we have had developing countries that had mobilized over 130 billion in concessional grants. And this will be funded over the next 3 to 5 years. So again, this is positive news for possible job creation, etc. So I think my question to you is, I'd like to get your thoughts on what maybe would be required in order to manage the potential trade-offs that would be associated with this major economic restructuring, especially for maybe workers and vulnerable communities.
Yeah, so in the first place, I think it has to be said is that there is people tend to, I think, to a large extent, there's going to be a cost to the transition to renewable energy. That there's going to be a cost. But we've got to get going with it because the cost is minimized if you accelerate your investment in renewable energy and you put the renewable energy infrastructure in place. Then as you wean yourself off fossil fuels, the disruption to your economy need not be that dramatic. And at the same time, the disruption to labor need not be that dramatic because we are talking over a period of 10 to 20 years. And in the mining industry, you are not talking about an enormously young labor force. So the impact will be there, but there is a very long period of transition which might help to mitigate the impact on labor. Then, of course, another thing you could do if you're really serious at accelerating this transition is you could reskill and retrain people. But in South Africa and in many, many parts of the world, this is often something government says, but they very rarely do. And they very rarely do successfully. So if advanced countries are not exceptionally good at reskilling and retraining their labor force, I wouldn't put too much trust in South Africa's government having much success with that. So it really is about allowing enough time to make that transition so that people can naturally migrate from fossil fuel to your renewable energy sources.
Nikki, I'd like to use the next few minutes of this session just to get your thoughts on, the global economy outlook, South Africa's domestic, economic backdrop. Earlier on, we mentioned how, the rand did relatively well on the back of this budget, even on a day where we saw the US dollar doing particularly well. And I think, the reason for that being the very strong inflation numbers that we saw coming out of the US. Of course, global inflation expectations do have implications for South Africa, as you have highlighted for us. Maybe just give us a sense of, how concerned are you about global inflation? Are global central banks reading this wrong? Yes, they are pulling back or turning off the taps, but are we likely to see, inflation really, really surprise more often on the upside, and are we likely to see interest rates coming in a lot quicker than we expect?
So I think that global central banks certainly got the inflation story wrong. They are quite right in that the fundamental root cause of global inflation at the moment is transitory of nature. And it relates to a lopsided global recovery, to the fact that you've got one part of the world economy rebounding very strongly, so demand surging. You've got the other part of the world economy, they don't have access to vaccines, still dealing with COVID, still got lockdown, and production and transportation networks disrupted as a result of that. And so you've got this demand-supply mismatch, all right? But that in itself is the definition of inflation. Too much money chasing too few goods. That is essentially the definition of inflation. So yes, they are quite right that the root cause here appears to be transitory. If the world collectively can overcome COVID-19 and we can see lockdown lifted all over the place, then supply conditions should normalize, and as a result of that, inflation and price pressures should also start to moderate. So they're right about that, but what they were wrong about is exactly how acute that pressure will become. And I think it was already, we wrote in a note, I think in January or March last year, that transitory could prove to be over a year. And I think that that has indeed been the case. So the reality is that they did get it wrong. And now they are trying to normalize monetary policy. And given that the general anticipation is that your supply side disruptions will probably continue into next year, because the big thing now is the race to get the developing countries, not the developed, not the rich nations, your emerging and developing countries vaccinated so that they can permanently lift lockdown restrictions. So that's the big race now, and that's going to take time, and it's not going to happen quickly. So in our opinion, we're probably still going to live with higher than acceptable levels of inflation, at the very least in the first half of next year, but it could even extend for the whole of next year, which means, in my opinion, that the Fed, as much as they want to put distance between the tapering and the rise in interest rates, will probably have to embrace the possibility of higher interest rates in the second half of next year. And so that's the result. And what does that mean for us? It means we're going into, I think, a fairly volatile period. We've already seen with the rand, all over the place, then strong, then weak, then strong, then weak. It really is impossible to forecast. So you've got that volatility. At the same time, you've got the Reserve Bank that needs to provide that needs to build in a little bit of a policy buffer there, so that they can deal with any shocks coming our way. So they're going to start moving interest rates higher. At this point, it appears unlikely to completely derail the local recovery, even as interest rates go up. But it's very difficult to say, because we're still dealing with COVID and we're still dealing with the threat of future lockdowns. And as we speak, we are on a level 1 lockdown. So we've been in this state for a while. And so higher interest rates on top of all of these other uncertainties, plus constant electricity shortages, might do more damage than the Reserve Bank's anticipating, or we're anticipating at this point. So it's very difficult to say. But generally speaking, in theory, if you just run the numbers through a model, it will result in slower growth in consumer spending, but it won't derail the recovery. But yes, overall, you are looking at a situation where you've got all of those uncertainties, and I think it is probably going to be more volatile 12 to 18 months than anybody is anticipating at this point of time, both globally and on the local side.
Next week, we'll be looking to the South African Reserve Bank and their interest rate announcement. We've been lucky, so to speak, because we've seen some of our emerging market peers who've had to hike interest rates quite aggressively, the likes of Brazil coming to mind. What are your expectations for maybe next week? And then, of course, just your inflation outlook for South Africa, and maybe what makes us different from our emerging market peers? Will we still be in this fortunate position that we currently find ourselves in now?
Okay, yeah. So the reason that Brazil and Chile and Mexico and Colombia had to hike interest rates, including Poland, have also started hiking interest rates. Hungary has also started hiking interest rates. So we definitely a laggard. All other emerging markets have moved far more aggressively. Is also because they've had much higher inflation. That doesn't apply quite that much to Poland. It doesn't even apply as much to Chile. Their inflation is more or less where we are, and they've already moved. But in Brazil, definitely, you've got inflation rising well above 7%, well, it's around 9% now. You've got producer inflation in all of those countries well over 20%. Our producer inflation isn't anywhere near that. And our general inflation is around 5%. We now got a situation where our inflation is below the US inflation. So inflationary pressures have remained fairly contained in South Africa. Now, unfortunately, it's remained contained for bad reasons. Okay, the biggest reason inflation has been contained in South Africa is because the recovery in domestic demand has been subdued. There's been a recovery, but it's been subdued. And very importantly, it's extremely price sensitive. Consumers are very price sensitive. That means companies don't have pricing power. They can't pass cost increases onto consumers without hurting their sales volumes. And that means the only way to move volume is to discount. And so that's essentially what's been keeping inflation in check. Do we think that's going to go away? No. We don't think that's going to go away. South African demand will remain selective. It will remain price sensitive. Companies will continue to have very limited pricing powers. And therefore, they will continue to have to consider pricing very carefully. And they also will maybe have to absorb quite a chunk of rising costs on their side of the equation. So, our inflation picture or our inflation assumption is that inflation remains at its current level over 5% until about June next year. And then it starts to dip, falling below 4.5% by the end of next year, and then averaging just below 4.5%, 4.3% over the following 2 to 3 years. So we see inflation very much contained. Now, with that kind of inflation forecast, you might say, well, there's no reason for the Reserve Bank to hike interest rates. But the reality is, given the global environment, given the fact that we still need to attract capital to South Africa, given the fact that we do run a very big budget deficit, and we do need a buffer if we are entering an environment where capital flows are likely to be more volatile, risk appetites are likely to be more volatile as your major central banks make this transition from hyper-accommodative monetary policy to more normalized monetary policy, you are likely to see eruptions. So you need a bit of a buffer. And from there, we do anticipate that interest rates will go up. Listen, on tomorrow, on next week, it looks like the Reserve Bank might go with 25 basis points. In our opinion, they don't have to. They can wait a little bit longer, but that will then mean they'll have to act in January, and they'll probably have to hike then. So, it's a 50-50 situation. The current inflation picture certainly doesn't scream, go out there and hike interest rates. But the markets have largely discounted that possibility, so they're anticipating it. And it does look as if the Reserve Bank's getting quite nervous about being one of the few central banks out there in the emerging market universe that have not hiked rates. So they're probably going to go with a 25 basis point hike and then another 100 in 2021, followed by another 100 basis points in 2022. So that's seems to be the route they're going to go. That's what their model suggests. We think that by the time they get to 125 basis points, or put it differently, 1.2 or 1.3%, if you like, up from where we are now, by the end of 2022, they're probably going to find there's very little reason to hike further. The only thing that I think that would motivate them to hike even further in 2023 is if indeed they manage to lower the inflation target. Now, there's a drive on the go at the moment to do that. National Treasury is evaluating the options as far as that's concerned. I think the Reserve Bank wants to drop the target to 3%, which is low. And then in that case, yeah, then I think interest rates will go up by exactly the amount their model is suggesting. So it depends on what happens to the inflation target over the next 2 to 3 years as well. So that gives you a picture of what we're saying. We're saying at this point, you probably got 125 basis points in it, but be aware that the Reserve Bank's model is saying there's 225 basis points in it.
Nicky, thank you so much for your time and your insights as always. Unfortunately, we are out of time. So much more that we could certainly talk and ask you about, but really appreciate you being with us today and breaking those numbers down for us. Of course, that was Nicky Weimar. She is the Group Chief Economist at Nedbank. Well, we are 11 o'clock on the dot, which means we have come to the end of our session. Thank you so much for making the time to join us. Of course, also a very big thank you to the production team. But before we go, we do want to get your feedback and hear from you so we can continue on improving on the webinars that we do bring to you. So a QR code will come up, and how it works is you just pull out your phone, go onto the camera, hold it up to your screen, and it'll be 1 or 2 questions in order for you to give us that feedback. Well, that's it from us. So we hope that you have a fantastic day further, and do take care. It's goodbye.